Hi guys, and welcome to Trading and Investing with Carl. In today's video, I'm going to give you a market update and outlook. First of all, we are going to start with the CAPE ratio. The CAPE ratio is the cyclical adjusted price to earnings ratio by Schiller. The ratio is calculated by dividing a stock's company price by the average of the company's earning for the last 10 years adjusted for inflation. In March 2001, the CAPE ratio was 32.3. In September 1929, it was 32.6. At the moment, we have a CAPE ratio of 34.8. That is no problem for traders, but for investors, it could be a problem. This is a long-term indicator. This means it's not going to predict you a crash within 1, 2, 3 weeks or a day. This is going to tell you whether the market is overvalued or undervalued. And at the moment, it is extremely high valued. That means for an investor, if he buys now and we say, even if it goes up another 5 to 10% and then it drops 40, 50, 60 or even 80 like in the dot-com bubble, then he lost a lot of money. So this is not an investor's market. This is a trader's market. Please always keep that in mind. And if you want to invest, please look how the company or the asset you want to buy is valued. Is it fair, under or overvalued? Next on, we are going to talk about the rise in the 10 and 30 years US Treasury bonds. The rise is because the market thinks inflation won't be temporary, like some central bankers say. They think inflation is going to be worse than predicted, so the rates are rising. Just think about that. A normalization to pre-2008 levels would cause US corporate profits to collapse by 50% due to the increased interest payments alone. And if we think a little bit further, if they would be on 1970s peak level, it would result in total elimination of all US corporate profits. And also funny to see, for the first time since March 2020, the 30-year Treasury Bond real yield, so that's the yield minus the official inflation, is positive. On this chart, you can see some kind of correlation between rising rates and corrections in the market. You can see here, we have this rise. What is going to happen here? We had here the rise of rates in 2008, and we got a 12% correction. You see here, we got the rise of rates. We got a correction. You see here, we got a rise of rates. We got a correction. You see here, we got a rise of rates. We got a correction. It doesn't indicate it has to be a correction. It is just showing you there is some kind of correlation between rising rates and dropping stock markets. Because people, when they get higher rates, they tend to go to risk-off assets like bonds instead of risk-on assets like stocks. Also, please keep that in mind. The corporate debt levels are at an all-time high. Since the 2008 crisis, they skyrocketed. This is not a problem we had only after the 2008 crisis. The whole story began after the Second World War, but it escalated after the 2008 crisis. So please keep that in mind. The debts are also at a very high level, and if the rates rise and companies have to pay high rates for their debts, that is going to affect their profits and is going to affect the market. Another thing, Gamestop is back in the game. Gamestop rose without any news, again 200%. Most certainly, this is driven by out-of-the-money calls with an early expiration. To be specific, the expiration tomorrow, Friday, the 26th of February. You also can see a high volume increase in the calls. Also a little fun fact, even if you bought puts, you could have made money because rising volatility affects the puts in a positive way. And this time is a little bit different. There is no significant short squeeze like the last time. You can see here, the short squeeze, the price went up, the shorts went down. And at the moment, please correct me if I'm wrong, we are at around about 31.2% short interest. So it's not only because of the shorts. And here you can see a chart from Goldman Sachs. It shows the performance of the most shorted stocks. You can see the performance is overwhelming. And that should make you cautious. You can see here, we had it in 1999, in 2000, we had it in 2009, we had it in June 2020. So please keep that in mind. Here you can see also a chart from Goldman Sachs that shows the median short interest of stocks in the S&P 500. You can see it is at record lows. This either means people are extremely euphoric and see no risk in the market, or people are afraid to short the market because they think they get run over by the bulls. Both things should make you extremely cautious. Next on, we are going to look at some technicals at the chart. So, first of all, let's start with the Nasdaq 100. You can see here we got this bullish uptrending channel. You can see it bounce back and forth, and this was a small dip out of the channel because of the thing with Gamestop, and people thought hedge funds are going to collapse, and some of the hedge funds had to sell some of their positions in some of the stocks of the Nasdaq. So this caused a small drop. But now it's a little bit different. We broke out of the channel and tested this very important support level. We bounced strong back but didn't get into the channel. Now it's going to be interesting if we get a retest of this breakout down and break through this level. This is no financial advice, as always. Please keep that in mind. This could be a good short entry. You could enter here and short the market, because if we break this support and we get a retest of this breakout downwards of the channel, this could be an opportunity to short the market. This also shows the sector rotation, that people want to get out of growth, tech, and instead buy a value like financials and energies. Next on, we have the S&P 500. Here it looks a little bit different. We got the same uptrending channel. We got the same breakout to the downside because of the Gamestop story. Got a strong bounce back in. And here we bounce back off the support of the channel, and the trend is still there. You also could, if you want to, you could trade the upside. There is a possibility that we reach the upper end of the channel, but the risk-return ratio isn't that good. Next on, we look at the Dow Jones. You can see here this kind of supports my thesis with the sector rotation, because you can see it is way stronger than the Nasdaq. And in the Dow Jones are more value stocks than growth stocks. Here are more of the energies and financial stocks at home. You can see here the strong support and buy area. But this was once a resistance area. We got rejected once, twice, 3 times we got rejected. Finally, we broke through, got a retest, and we bounced back and forth in that area. Now we broke through. It would be good to see if we get a retest, and then maybe if the retest confirms the trend, you could trade it. But here also it is a very difficult market to trade, and the risk reward ratio isn't that good. So please keep that in mind. Here we got Bitcoin. Here you see we had an ascending triangle even if it was in a downtrend. Let me draw it for you. So let's make it a little bit thinner. So you can see here we have something like an ascending triangle, but it's still in a downtrend. You can see here this whole area is a resistance area. We broke through it a little bit, but we didn't get the retest, so we are still back in that pattern. It's going to be interesting to see if we break to the downside or to the upside, but this was a first good sign for the upside, but also a bad sign because we didn't get the retest. But the statistic likelihood is that we break to the downside because we are coming from a downtrend. So it's going to be interesting to see if that happens. Also, I see here we got this. Wait, I draw it for you. Also, you can see here we got a strong buy area. We bought it once, twice, 3 times. We bought it 4 times. So this is a strong support area. Next on, we have here the 30-year Treasury Bond. You can see here, this was when Jerome Powell said inflation is going to be no problem. You can see the market doesn't trust him. It bounced back up and got even higher. So it's going to be interesting if the rates are going to rise further. With that all said, as always, thanks for watching. If you liked it, please smash up the like button. Maybe subscribe to the channel if you like this kind of content. And as always, good luck with your trading and investing. Always stay cautious and please don't get wrecked, people.